Welcome to this week's market update. I will be traveling over the next couple of weeks, so we won't be putting out an update, but I do want to leave you with some information in the meantime. I think right now we are looking at a situation that continues to evolve in the Middle East. Unfortunately, we can't pretend to know how or when the war will ultimately be resolved, and that's uncomfortable. But I think it's really important to understand what has changed and what hasn't during this conflict. So let's rewind the clock and think about our positioning and outlook at the beginning of the year. We came into this year with a neutral allocation to equities. That means that in a typical portfolio that might allocate 50% to stocks or equities, we were right at 50%. That was a reflection of a market whose valuations had reached elevated levels after 3 really strong years, and our own understanding and acknowledgement that we were starting a midterm election year where generally policy uncertainty can create additional volatility. In fact, in the average midterm election year, we see the S&P experience a drawdown of about 19%. So we were prepared for volatility. We understood it was possible. We were positioned appropriately for it. What was the reason for not pulling back even further and de-risking portfolios even further? And the answer is really that we saw a few primary catalysts for the market at the beginning of this year. The first was we expected the Fed to cut rates. We also looked at an economy that continued to be on solid footing. Sure, there were areas of weakness in the economy, but we were also seeing AI or capital expenditures across artificial intelligence continue to increase. That is certainly providing support for the economy. We also saw fiscal support in the form of the One Big Beautiful Bill Act, which was passed last year and was going to provide a lot of support to households in the form of tax refunds as well as corporations. And then finally, we were looking at earnings projections, which were showing that profitability among corporations, specifically within the S&P 500, so the large cap space, was continuing to climb. So these were really primary supports heading into this year, and one of the reasons that we didn't want to take too much risk off the table. So what's changed? Well, really the only thing that's changed so far is that first one, the fact that we are no longer expecting the Federal Reserve to cut rates multiple times this year. We know that inflationary pressures have picked up, and we've seen the bond market price out expectations for the next Fed rate cut. Actually, some are expecting the Fed to increase interest rates. We don't think that's necessarily going to happen. We think that would be a stretch. But we do think that the odds of a Fed rate cut have been greatly reduced as a result of the developments over the last month. What hasn't changed? Let's focus on that second point I brought up, that second catalyst, the fact that the economy was on solid footing, and it still is for the most part. Now, I'll acknowledge that higher gas prices are putting additional stress on households, particularly those in the lower income tiers that are already really feeling a lot of pain in what we've been calling this K-shaped economy. But I will also acknowledge the fact that if we were looking for areas of weakness, one of the things that I'd be looking at is are layoffs increasing as a result of the stress over the last month? And right now, we are not seeing that. We're fortunate to have access to initial jobless claims data. This is data that comes out every week. And this tells us how this is a great read into our layoffs increasing. Are they spiking? Because this is a reflection of whether individuals are filing for first-time unemployment benefits. So if you see a spike in layoffs, you're going to see initial jobless claims increase. We are not seeing that yet. It actually remains very, very low. So that's a great sign for us so far. Finally, I will acknowledge that earnings growth continues to look very strong both for 2026 and for 2027. We've actually seen earnings growth expectations increase for all sectors of the economy over the last month, which is kind of surprising, but it does explain why the market has not fallen further. Sure, we've seen some pullback, and I think that's to be expected in this period of geopolitical uncertainty. But when we are asking ourselves, is this something that should really cause us to alter portfolios or position differently? We're looking at these catalysts to help determine and inform our decisions. And it tells us that we are still good. We'll be keeping an eye on these things, certainly in the weeks to come. I think the earnings part is going to be big, really starting in a couple of weeks when we start the first quarter earnings season. We'll get to hear from these companies, hear about how the war in the Middle East is impacting their outlook for their own businesses. But right now, earnings growth is expected to continue and remain very, very healthy for 2026 and even 2027. For that reason, we are comfortable with our positioning. As I said, we'll continue to watch this as things progress here. We don't like being in the fog of war just like everyone else, but I think right now being disciplined is very, very important so that you don't join in the panic. I'll leave it there for now. I'll look forward to seeing you all in a couple of weeks. But if you have any questions, as always, please don't hesitate to reach out to your advisor.